people who want to invest in your company, they check that what is the borrowed fund, the amount which you have before covering the certain things, that is the income tax as well as the interest. We call that as ICR. It's called DSCR. We call that as what? Debt service coverage ratio. Hello everybody, a warm welcome to one and all. I'm Vidhyaashram from the Department of Business Studies in Vidhyaashram PU College, the Temple of Excellence. Welcome to the session 7, and session 7 is all about the factors and what are the considerations. Now try to understand the session 7 here. Now, choice of capital structure. Now I told you about what exactly a capital structure is in the session number 6. Now you are supposed to watch the session 6 and then only you will understand what exactly we talk in the session 7 and the forwarding session 8, 9, 10. So try to understand what exactly a capital structure is. Now when we go with capital structure, it's all about what? Two things, that is a mix. That is, it is a mixture of, one is equity and another is debt. Now here what happens is you have the owner's fund as well as the borrowed fund. Here when we talk more about the owner's fund, it's all the equity share capital and the equity shares here. So we have the equity, and when it comes as the borrowed fund, it's all about the debts we actually have. So try to understand where the risk is more. The equity, the risk is more, because if profit happens, the equity shareholder will get the profit. If it is a loss, what usually happens? The equity shareholder should bear all the losses because he is the owner of a company. When we say he's an owner of a company, that means the owner should bear the losses as well. But when it comes to debts, what exactly happens is, once the company has borrowed from somebody, when they borrow from somebody, what exactly happens? They'll go for an agreement. What exactly the agreement is? The agreement is principal amount plus the interest is what they are supposed to pay. That means whatever the amount we have taken from the borrowers, right? That is, we have borrowed, like banks you have, then financial institutions you have, and you have debenture holders, and one more is the public. So I have told you in the session 6 that what are the borrowed funds. So we usually have the borrowed fund, like we have the bank which gives us the money, then we have the financial institutes who also give us the money. So what is the obligation towards them? The obligation towards them is we need to pay certain rate of interest. And whether you make profit or you don't make profit, what is that you are supposed to give? You are supposed to give them the interest. So here what happens is the debt holders, whoever are there, they are safe than the equity shareholders. So we need to go for the choice of the capital structure. So here deciding about the capital structure of a firm involves determining the relative proportion of various types of fund. So when you go for a proper choice, you are supposed to decide. Now when you are supposed to decide, you will actually come across which one should I actually go. And there is always a question mark saying that which one we are supposed to prefer. And try to understand this. The more loan you are taking, what usually happens is, whenever we take loan, there is an obligation to pay the interest plus the principal amount. So here what happens, when you take more and more loan, people who want to invest in your company, they check that what is the borrowed fund. When they check it and they get to know that the equity fund are less, that is the owner's fund is less than the borrowed fund, usually what happens is people don't want to invest in certain companies. So that's why you should always go with what? Debt recover. When you understand what is debt recover, that means the way you are giving back the debts, only then you will be getting more shareholders. So that's why it is very, very useful. For an advice, if I need to give it to you, please check the company's formats the company's ledgers and the other accounts, only then you are supposed to go and invest in the company. So here the choice is also what? Whether you will go for a borrowed fund or the owner's fund. Next one, for example, debt requires regular servicing. What is that regular servicing? Why will a bank or a financial institute will actually give you or lend you the money? Because you are supposed to go with what? Interest payment. That is, you need to go for a regular service of what? Interest payment and repayment of principal or the obligatory on the basis. When you go for that, what usually happens is you are supposed to know that the principal amount, whichever it is there, you are supposed to pay them back. So the next one here is we have the factors which affects the choice of capital structure. What is it? Factors affecting the choice of capital structure. The first one here you have is cash flow position. So these are the factors which affects the choice of capital structure. One is the cash flow position. Second is interest covered ratio. Please understand all these things are very, very important. ICR, interest covered ratio. In your undergraduate, if you join your BCom or BBA, you are supposed to know all these terms called what exactly is interest covered ratio. The amount which is covered, that is coverage, that is called interest coverage ratio. Next is you have debt service coverage ratio. See, when you have this debt service coverage ratio more, that means what? People feel that whatever you have borrowed, you have the amount to cover those things. That means you have the potentiality to repay the amount to the people where you have taken the money. Next one is return on investment. Try to understand this ROI. ROI is very, very frequently used term whenever you invest anywhere, right? You invest for a business or you lend somebody the money or whatever, you start investing it, you should always find out what is the ROI, return on investment. If you get more money than whatever you have invested, only then you are supposed to invest. See, I know that in a business you have risk, but you are not supposed to take unnecessary risk. So that's why we always calculate ROI more. So you have this 4 choices of factors which affects the choice of the capital structure. Now I told you about what exactly a capital structure is. It's all the mixture of owner's fund and the borrowed fund. Still you have 3 more categories in the choice of which affects the capital structure. Next is cost of debt. On what cost you have actually taken it. Tax rate. Tax rate is very, very important. So please take more concentration and you are supposed to give more concentration so that you will understand what exactly a tax rate is all about. And tax rate depends on country to country, because you have something called the fiscal policy which always changes according to the government which comes to the country. And the lastly you have is cost of equity. The way you have cost of debt, you have cost of equity. So cost of debt and cost of equity, if you understand, you have understood the capital structure, is what I can guarantee you. So let's go one by one. The first one, the factor which affect the choice of capital structure is cash flow position. Whenever I say cash flow position, please understand the term cash flow, right? That means it is not a particular thing which actually flows like a water. Try to understand what exactly a cash flow is, right? Size of projected cash flow, that means a particular thing, you have a project where how much money is supposed to be incurred is what you are thinking that must be considered before issuing debt. So you should always know and calculate how much you are supposed to take the debt. Now cash flow must not only cover fixed cash payment, that is, it should not be only like fixed, you are supposed to go with all the things, that is, you have fixed, you have variable, you have all the kind of other things, obligation, but there must be sufficient buffer. Also it must be kept in mind that a company has cash payment obligation. Try to understand this cash flow here. Now you have a company called ABC. Now it is into a venture. When I say venture, it is into a business. And what type of a business it is? It is dealing with some kind of a business where you have a project. Now you need to check how much is the cash flow for the project. Now the cash flow should not only consider the cash which is fixed kind of a thing where you'll go with covered fixed cash. You are supposed to also go with a buffer, that is if it reaches, example I'll tell you, now you have a project of say 1 lakh rupees. Now you should decide that should you borrow or you are not supposed to borrow. When you start borrowing, what is that you should do? Though the project is only for 1 lakh rupees, you are supposed to borrow something more than that. The reason is what? You should have a buffer. You should have what? You should have a buffer. Now buffer also must be kept in mind that company has cash payment obligation. Now here what happens is whatever you have actually borrowed, working capital is there. Every day you are supposed to work. So for that you also should have more money. That's why cash flow is very, very important. Next one we have is interest covered ratio. Understand the interest covered ratio. We always call that as the ICR is equal to EBIT divided by your interest. Right? Interest. Now what is this EBIT? Earning before interest and tax. What is it? Earning before interest and tax. I'll just write it here. Earning before interest and tax. That means whatever you get, and that is calculated before the interest and the tax. Interest is also subtracted and your tax is also subtracted. Now the interest coverage ratio referred to the number of times earning before interest and taxes of a company covers the interest obligation. Means what? Whenever you have any obligation, you will calculate it before EBIT divided by the interest which you are actually getting it or giving it. Interest. This is called ICR, interest coverage ratio. The amount which you have before covering the certain things, that is the income tax as well as the interest. We call that as ICR. Now we'll go with the next one is DSCR. Very famously it is called DSCR. We call that as what? Debt service coverage ratio. Debt service coverage ratio. What exactly it takes care? It takes care of the deficiencies of referred to in the interest coverage ratio. So that means what? Whatever it covers, you will actually get to know what exactly it is. It is calculated as follows. I have given you an example. A higher DSCR. Now you have the coverage ratio. You are getting the debentures. You are actually getting the loans. What exactly you do is you should pay it back. So when you have certain amount, that is you have a coverage ratio saying that I can take 10 lakh rupees. Now I have the potentiality to give the 10 lakh rupees back with interest. We call that as the debt service coverage ratio. The word is what? Coverage. I have the capacity to cover it. So that is called debt service coverage ratio. Here it is calculated by kind of a thing, that is higher DSCR. The more you have DSCR, that means what? It indicate better ability. So what exactly it is? It's all about the ability, coverage, right? To meet cash commitment and consequently the company's potentials to increase debt. See, when I have 10 lakh rupees I have taken from somebody and I have the money to repay them, what will I do is I can actually opt for more loan. That is what it is, right? Increase that component to its capital structure. When I have more fund, definitely to increase the business, increase the productivity, increase the company's expansion and all, I can go up for more debts and then I can take it. So that is called as DSCR, right? What is that? DSCR, that means debt service coverage ratio. What exactly happens is take care of all the deficiencies referred to the interest coverage ratio. Next one is return on investment. What is this return on investment? I told you before itself, right? If the ROI of the company, ROI is return on investment. If the ROI of the company is higher, try to understand this. If it is higher, it can choose to use trading on equity. See, when somebody, that is the shareholders, are investing in the company, and my rate of investment is more, I can actually go for what? Equity. I can play with equity shares. That is, my earning per shares are getting more. So what happens is we can actually go for the equity to increase its EPS, its ability to use debt is greater. Now try to understand. When I have more return on investment, right? I'm getting it. Now it is what? It is a growing phase. When I say it is a growing phase, ROI is an important determinant. What is it? ROI is an important determinant of the company's ability to use trading on equity and thus the capital structure. So we can actually go for what? Trading as well as the capital structure. So that is why ROI of any company, whenever they go with return on investment, it should be more. If it is less, then there is a problem. Next is cost of debt. What is this cost of debt? You have cost of debt as well as cost of equity. You are supposed to know what exactly those two terms are. A firm ability to borrow at a lower rate. What is it? To borrow at a lower rate increases its capacity to employ higher debt. See, now I'll go with 10 lakh rupees, right? Now I'll think about this and then I will go with 10 lakh rupees. I'll start borrowing. When I start borrowing 10 lakh rupees at a low rate or lower rate, okay? Now what happens lower rate? It increases the capacity to employ higher debt. So I can actually take more than 10 lakh rupees, right? So that is what is called the cost of debt. Thus, more debt can be used if debt can be raised at a lower rate. We call it as cost of debt. You should always minimize the rates. That is the interest rate. When you minimize interest rate, you can actually opt for more debt. That is what is called the cost of debt. So hope you are getting the concept. Try to understand. The first concept is what? The concept is whenever you buy any debts, okay, whenever you buy, you are supposed to give interest. So what is this cost of debt? That means you should always try to minimize the interest rate. When you minimize interest rate, you can actually get more debts. That is what is called as the cost of debt. Next one is tax rate. Try to understand this tax rate. Since interest is a deductible expense. Interest is always what? Deductible, because it goes from you. Cost of debt is affected by the tax rate. Certainly yes, right? If tax rates are more, what happens is you are supposed to pay more. The firm in our examples which I have taken is what? At 10%. Now I have just given you an example here. The firm in our examples are borrowed at 10%. Since the tax rate is 30%, I'm just giving an example here. Now I'll just tell you, now you have borrowed at 10%. You have borrowed at how much? 10%. And then what has happened is the tax rate is there. And that is 30%. The after tax is debt is only 7%. The reason is when you have borrowed, understand this, cost of debt. When you go with the cost of debt, you are supposed to minimize the rate of interest. When you minimize it, what happens is you can actually buy more. So try to understand, though the borrowed at 10% and then tax rate is 30, if you go for the cost of debt, what happens is the tax rate should be there. So the borrowed rate will be for 7%. So when you go for it, it will actually come. The higher tax rate thus makes debt relatively cheaper. Higher tax rate, because the tax rate is how much? 30%. A higher tax rate thus makes debt relatively, so here what happens is cheaper and increases its attraction. Vice versa, the equity. So that is what it will happen. So here 10% was there. Now what is exactly the 10% of the 30? That is 10% you have of your borrowed. Now the tax rate is 30%. Now certainly when the tax rates are more, then what will happen to the borrowed fund? That will be like 7%. So that is what happens here in the tax rate system. Again, it affects the choice of capital structure. The last one we have is cost of equity. Now what exactly the cost of equity is? I told you about the cost of debt, the total kind of a thing. The same way here also the cost of equity, try to understand. Stock owners expect a rate of return. Who actually expect? The stock owners from the equity. From whom? From the equity. Now you have equity shareholders, right? What is that they do? With the risk they are assuming, so what happens is it commensurate. What exactly happens is with the risk they are assuming. They have assumed some certain kind of a risk. That is what it is. When a company increases debts, the financial risk faced by the equity holder increases. The reason is, see, equity shareholder will get the money only after the debenture holders, right? Debenture holders. When debenture holders are more, even if the company is making profit, they are supposed to get an obligation, that is they need to pay whom? The debenture holder first. They should pay the debenture holders first. Later, if it is saved, it goes to the equity shareholders. So there is a lot of risk if the debts are more, right? Consequently, their desired rate of return may increase. Now what usually happens? This is what happens. If when a company increases debts, that is borrowings are more, and financial risk faced by the equity holders increases, that means usually what happens, if I borrow more, that is the company borrows more money, firstly the company need to pay to whom? For the debenture holders, and later it goes to the equity shareholder. We call this as cost of equity. So these are the things which you are supposed to know. I know that it's like quite difficult for you to understand. Again, you watch these videos, again read the textbook and try to understand it. Then if you have any doubt, you can call us. We are there to help you. Thank you so much. I'll see you when I see you.